This conference will now be recorded.
This is me. I'm Emilie Goldman, founder of Tamarind Financial Planning. In my professional life, I'm a financial planner. I'm passionate about creating financial freedom for busy families. And to me, that means freedom from the anxiety and worry that can build up when we don't plan, or maybe we just don't even know the next step to take. Especially with investments where the media provides a constant stream of market news that can leave us feeling that we should be doing something if only we knew what that was. In my personal life, I'm a mom, and I know how challenging it can be to manage a busy family schedule, a career, and on top of that, find time and energy to focus on the longer term, big picture financial decisions. So I commend you for taking the time today. To start off, investing is not really about the markets. It's not about stocks or bonds. It's about people, and it's about having a plan. We won't just invest. You don't work hard, put money away, and say, I'm investing. You really have to have goals that you have documented. And these goals typically include important areas such as health, family, work, vision, values, lifestyle, retirement, financial comfort. As financial advisors, our goal is to find out what your passions are, what your concerns are in these areas. We take inventory of where you are now and where you want to be in the future, and we create a plan. When you do that, you take the typical 65-year-old couple today. They have 30 years of joint life expectancy, meaning there's a high probability that at least one of them is going to live to age 95. This means the number one objective for most of us is not running out of money. That's what most of us care about. It's not what the S&P did last month, although that can certainly make us feel scared or excited. But it doesn't matter what the money manager thinks about China or what may or may not happen in the market 3 months from now. It's really about the next 30 years, and that's a very long time to plan for. The number one question of my clients is, am I going to make it? Success is being confident you can meet your goals. And when you work with a financial planner, the financial software that we use can help us plan for those 30 plus years. And we base our projections off of historical market returns and realistic expectations. After all, what good is a plan based on unrealistic assumptions or data that goes against historical norms? That wouldn't be prudent or realistic. So we use our software and we get a score. Most planning tools have something like this that calculates the probability of success. Again, the probability that you will, given all of the assumptions, given all your goals, that you won't run out of money during your lifetime. Obviously, if we do a calculation and it shows you in the red zone, let's say here, where you might need to make changes. Let's say mainly you can't spend as much as you wanted to spend in retirement, or maybe you can't retire the date you wanted to retire. What if you put it off 2 more years? We can do scenarios like this to see what are your levers. What are the levers in your plan that you can control? What does that do to your probability of success? There are many things you can do regardless of the market to increase this probability of success. Certainly spending needs and retirement dates are tremendous levers, and there are others as well. This planning, you can see, is not based on getting lucky and beating the market. We use a much more conservative approach called the prudent investor rule approach to determine probability that uses historical rates and also some prudent expectations of rates of return. Generally, plans are based on the long-term rates of return for various asset classes, by which we mean, for example, small company stocks, international stocks, different types of bonds. And typically we are projecting within the 6% to 11% range, depending on what type of investments we're looking at, with small company stocks towards the 11% range and long-term bonds toward the 6% range. When you build a plan, you need to find investments then to actually implement the plan and implement the portfolio with. So then what do you do? So far, we've just been sort of talking theoretically, but how do we actually take action on this plan? So as an investor, you have thousands, really tens of thousands of investment options, many of which look pretty much the same to the average investor. But in our opinion, these boil down to a fundamental choice between active and passive investments. That's the first way we get a clear vision of all of our options. Here are the differences. Obviously, active managers have two things at their disposal. They can do market timing and or stock picking. So timing the market means being in or out of stocks depending on whether you think they're going up or down. And then stock picking, trying to pick the stocks that you think will do better than other stocks. So that's what active managers do. Passive managers believe in buying a diversified group of securities, and passive investments tend to be more tax efficient versus active. And since passive managers do not buy or sell as frequently as active managers, frequent buying and selling can have a real impact on taxes paid. Those are the core differences between active and passive. Again, you've got a plan built using historical market rates of return, using realistic assumptions, and we hope a good probability of success. The first question to ask yourself is, which of these two strategies gives you the best chance of getting those market returns that your plan is based on? This study looked at the performance of active money managers over the last 10 years versus Standard & Poor's indices. As you can see, over the 10-year cycle from 2008 through the end of 2017, the percentage of active managers that outperformed their benchmark was very low. That's the blue. For each bar there, that's the blue portion. Now, this isn't saying that active management cannot beat the market. Obviously, it can. In US stocks for the last 10 years, 10% of US stock active managers did beat the index. 90% didn't. And the 10% who did may not do as well in the next 10 years. The problem is that most active managers are reliably unpredictable in delivering market returns that your plan is based off. If your plan is built using historical market assumptions, and this is your outcome for active managers, would you implement your plan with these odds? Since it's so hard for smart money managers backed by a wealth of research and resources to beat the market, we think it makes sense for many investors to invest passively. The choice between active and passive investments is the first way we get a clear vision of our investment choices. Okay, so moving on from there, we have two more choices: index or asset class. Now, the two strategies have a lot of similarities. They both offer diversified exposure to groups of investments, and they both offer tax efficiency. Index funds and asset class funds typically both offer lower costs than active management as well. But the asset class approach offers a few things a little different than indexing. One of them is precision. Did you ever wonder what happens to the jelly belly beans that are a little less than perfect? Or the ones that somehow escape the jelly belly logo stamper? Well, those are belly flops. They weed them out and sell them at a steep discount. The same process applies to asset class investing. Managers are free to select the securities that best represent the asset class, so small companies, for example. They don't have to accept stocks that don't fit, like initial public offerings, bankrupt securities, and other things. They can weed out these belly flops from the portfolio. But index funds are typically stuck with the flops. They don't have the flexibility to make changes as stocks change. Indexes are typically reconstituted or sort of rebalanced to their asset class just once a year. If an underlying security migrates to a different asset class, so the company grows bigger, for example, and it's no longer a small company and now it's a large company, it won't be removed from the index or fund until its annual review, creating a disconnect between what investors want and what their portfolios own. Excuse me. Another difference is flexibility. Have you ever tried to fly, excuse me, during the holidays? You know how expensive it can be. Everyone wants to fly at the same time, and that drives prices up. But what if you could be more flexible about when you travel? You could expect much lower fares. The same is true of investing. The goal of an index fund is to track an index as closely as possible. That means a fund manager must buy a security the day it is added to an index. The end result of this process is called the reconstitution effect, is that the index manager must typically pay a high price due to the temporary run-up in price between the announcement and when the stock is actually added to the index. So all these index funds are buying the same stocks at the same time, basically, and the result is the price increases. So they're paying a slightly higher price than if they didn't do it on that day. And then we call that reconstitution effect. Additionally, index funds have no flexibility to execute or postpone a trade if the pricing isn't favorable. Asset class funds don't have to quote unquote fly during the holidays. They keep their options open to get the best price, both buying and selling. A third difference is the factors of return. Just as a car's performance is the result of a number of factors such as gas, oil, tires, spark plugs, aerodynamics, and so on, so is the performance of securities as a whole driven by a number of factors. These include size, so small versus large companies, value versus growth, profitability, and momentum, which is, we're referring to price momentum of the stock. Index funds can also be chosen to focus on sectors like small, large value growth, but they suffer from some of the same challenges around precision and consistency. So again, for example, if a small company becomes a mid-sized company, it will still be in the small cap index until that fund next rebalances or reconstitutes. A small cap asset class fund, however, would have the flexibility to start moving that formerly small stock out of the fund. Profitability and momentum are largely specific to asset class investing. And asset class investing is based on decades of academic research, including the work of 11 Nobel laureates. So all passive investments are not the same. When you apply all 5 of these areas, diversification, tax efficiency, precision of securities you want to own in the asset class, flexibility in buying the securities, and the academic research that shows what drives returns, what you're left with, primarily, we believe, are asset class investments. And this adds up, we believe, to this simple and powerful statement. We believe there may be a better alternative to index returns. And here's the data to back the statement up. Dimensional Fund Advisors, a firm we use to build our asset class portfolios, is a firm that's been managing asset class funds for the last 3 decades. They have performed not just against its Morningstar categories, which includes both active and passive managers, but also how its funds have performed against their benchmark indices. These are 5 of the fund categories that feature prominently in most asset class investing portfolios. In the dark blue, the far left of each of these columns is the performance of the DFA fund. In the middle is the Morningstar category average, and on the right is the column's benchmark. Let's take US large cap, the most liquid area of the marketplace. Dimensional's fund in this area essentially tries to mimic the S&P 500, and the only major things they do differently is they don't trade securities when the S&P reconstitutes. They either buy or sell the stock early, or they wait a little while. After their expense ratio for the last 10 years or so, they have added 54 basis points, or 0.54% above the index every year, just by doing that one thing. These little increases in returns compound significantly over time. In our opinion, asset class investing may offer all of these benefits. So lower overall costs, better tax efficiency, increased diversification, better risk exposure to an asset class, so more specific exposure, and then finally potential better long-term performance, which is really the point of doing any of this, to improve our long-term performance. Now, if we go back to the 30-year plan we started with at the beginning, and what we decided was our overriding goal, not running out of money. You could just put all your money in a fund that tries to mimic the S&P 500, but you would be missing out on the potential benefits of a globally diversified asset class portfolio. So let's compare these. Let's look at a portfolio built with asset class funds. In this case, a moderate portfolio that is 65% stocks and 35% bonds versus the S&P 500. Your own situation, especially your goals and comfort with risk, will determine what portfolio is right for you, but we're using this portfolio that's in the middle between conservative and aggressive. We're comparing to an all stock portfolio. And here's what happened from 2000 to 2017. This was one of the worst times to start investing in recent history. This period included 2 major market corrections as well as the Great Recession. Over this time period, a 65% stock, 35% bond asset class portfolio mix had an annualized rate of return of about 5.7%, while the S&P returned 5.4%. And volatility, which we measure here by standard deviation, was a lot less for the diversified portfolio as well. But since many portfolios are meant to help fund investors' retirements, we need to consider the impact of periodic withdrawals. Let's look at the same portfolio versus the S&P 500 for the same time period, years 2000 through 2017. But in this case, let's consider a newly retired 65-year-old couple withdraw 5% of the initial hypothetical value. So the values, hopefully you can see there, starts at 500,000. So the withdrawal would be 25,000 initially for the year, first year. Take it out at the start of each year, grow that withdrawal by 3% per year. Again, we picked the beginning of the last decade in 2000 to show you what one of the worst periods in modern times. As you can see, the diversified portfolio was worth over 300,000 while the S&P ran out of money. And keep in mind, $585,360 was also withdrawn as income from the portfolio, more than was initially invested. When it comes down to it, we think there are two numbers that matter above all else, 1 and 30. You may have one chance to put together a plan to last you 30 or more years in retirement. You can't keep changing your mind or give way to short-term emotions or constantly alter the way you invest. You need to have an investment approach you can believe in, one based on research, analysis, and evidence. And we believe you should work with a financial advisor who can help you keep on track. Because you can't control the market, you should make sure you have the highest probability of being able to achieve your long-term plan and realize your most deeply held goals. So that went a lot quicker than I thought. We definitely have time for questions. I also wanted to just pop this up on the screen. I do offer a free initial consultation where we can take a look at your retirement readiness. We can take a look at your portfolio structure and see what sorts of things you might be able to do to increase your probability of success, to even calculate it maybe if you haven't done a financial plan at this point. You can reach me through my website there, tamarindfinancial.com. The Get Started is also a button and a tab on the site, and there's my email on the screen as well. Check in the chat window here, so feel free to pop up any questions that you may have. And we'll wrap up in just a couple of minutes, see if we have any questions. I guess I must have covered covered this thoroughly. I don't see any questions in the chat box, but do feel free to be in touch. Again, retirement readiness assessment, you can reach me. You can schedule online on my website if you are interested to learn more. And from there, we are going to go ahead and wrap up. Thank you again for joining me. I look forward to being in touch.